way you want to do this, the way I see this working is you're looking at 3 stocks in 3 rounds. So 9 stocks, maybe more. And you're trying to get those down to 1. You've got to build, if you look at it, you got the financial analysis, you got the valuation, you got the relative valuation, you got the capital IQ model, and you've got the football chart. So my idea, and I know Joshua is actually helping him on Friday to learn these things. He's essentially passing it on. If you've got 3 companies, maybe 4, to give this person helping you one of those companies and have them build this for you. It doesn't mean you can't change some of their assumptions, but get all the data in. They'll learn how to build these models, how to do the analysis. Some of them are freshmen, so they've never seen beta or risk-free rate and all that, so we have to explain that to them. Some of them are taking the CFI course, the financial modeling, valuation analysis. It does not cover beta very well at all. For some reason, it does everything else really, really well. So that's the thought process. You can meet with that person and ask them to do it. Or you can tell me, hey, can you have my helper do this stock? And then I'll work with the person. So however you want to work it, all right? We see how that works. So it's essentially someone to help cut. It's not going to cut your workload 100% on the stock, but it might cut it 80%. So they'll get all this data loaded, get it off of Bloomberg, do the charts, do the analysis, put the assumptions in. And then if you want to go through and check the assumptions, see if you like them or not, you can go back and make that analysis. But it's good practice for them, gives them something to talk about when they're interviewing. It won't be a massive amount of work because you can probably do all of these for a company in 2 or 3 hours, probably pretty easily, and get them all set up. And then you have a company done. So that's the goals. Any questions on that? Now, you might have a preference for who you want to help with you, but I just did it partly randomly. And then some of them have preferences for tech, or a lot of them want to do tech or industrials. I don't know why industrials. That's not usually when people pick. None of them picked consumer stocks. It doesn't make sense to me because that's what I would pick as a freshman. But so Joshua will help some with that. He missed all of that, but I'm sure he'll be agreeable with it. So thanks, Josh, for helping set all that up. That really helped. All right. The second thing I was going to mention is next Tuesday, I might do another one of these quizzes. I want to make sure, I'm a big believer in retention. I was just talking to an alum tonight. We were talking about what AI is doing to people. I still think you should know stuff off the top of your head. And what we're doing in this class, don't put it in your notes so you can look it up. You need to know it off the top of your head. So what we're talking about is you're in an interview and they say, how would you analyze a firm as a potential pick for my portfolio? Or you're starting your job and they say, if the training's like I got, okay, Ryan, you're our security analyst, do the job. It's like, where's the training? There's no training. You're supposed to know it. It's like, thanks a lot. I was an accounting major that switched to finance, so I really didn't know what I was doing. So what would you do? Well, you should know this off of your head. I'm giving you the templates. I'm giving you the format. Go with this, but have it memorized. Know it off the top of your head. So you start off with an industry analysis. What is that in? What's the biggest template we use there? What did y'all use there? Orders. If you do that on a job, they're not going to say, where in the world did you go to school? It's perfectly logical. It's what you should do. Anybody remember Porter's? How many factors are there? 5 forces. Yeah, I remember them. Buyer, seller. Robbery through the industry. Barrier to entry. Threat to subsidies. It's pretty easy. What are the generic strategies? Does your industry have a cost leader? If it's differentiation, how did they differentiate? Are there any focus strategies? Can you do that off the top of your head without looking it up? That's what you should be able to do. And then you're going to do you do a stock screening model, you might talk about that. Essentially just explain what we did in class, right? You could do the one we did, which is the ranking model, which I think works pretty well. It was interesting with the consumer discretionary, we brought in some international stocks and it liked Volkswagen, right? Didn't like Honda, didn't like, forget the other one we did, oh, Toyota, but it liked Volkswagen. They've got to decide whether they're going to do international stocks or not. We probably can't do 3 international auto manufacturers, but we probably could get away with buying one if they have an ADR. But a screening model, so you talk about those things. Well, the wonderful thing about the screening model is the next thing is financial analysis. What's in your screening model? It's your financial analysis, right? It's liquidity, it's solvency, it's return on capital. Liquidity is working capital and free cash flow. Your long-term prospects for growth is what? Turnover and margin. Your return on capital is what? Return on capital, ROE. So your stock screening model and your financial analysis are one and the same. You don't have anything extra to add. Your financial analysis is your definition of what is a good company. You're going to use that exact same model to rank good company versus good stock. That is the one question I always ask in my interviews. Define for me the difference between a good company and a good stock. When an undergraduate student does that, they look at me like they've never heard it before. If they're from UT Austin, they use the word team in every sentence, which makes no sense. You don't work in teams in finance, you work individually. For some reason at UT Austin, they taught them to say the word team all the time. What is a good company? What is a good stock? So I asked a recent graduate that question, and they can't answer it. Most of them say they have a good current ratio. It's like, oh, the one ratio I don't even like. I asked someone who's been in the business for 10 years, they pull out their briefcase, a stack of paper that high, and they want to talk for the next 6 hours. That's the difference. Which one of those people do you want to be? Do you want to sound like a college student or a professional when you interview? I want to sound like a professional, right? So first thing I'm going to do industry analysis. I want to know if this is a good industry. I love Porter's analysis. I think it really works really, really good. We're looking at buyer power, blah, blah, you go through all that. Once I do the industry analysis, I have an understanding of the industry. Now I want to screen for some stocks to get on my buy list. I want to know good companies. My good companies, man, they manage working capital well. They produce free cash flows. They have good credit ratings. They have good turnover, and the turnover is improving. They have good margins. The margins are improving. They have good return on capital. They don't overuse debt. Those are good companies. I want to find those good companies that aren't too expensive. Anybody know what that's called in finance? What's the most popular model in finance? What is GARP? I call it QUARP. What is QUARP or GARP? That's what your model is. You just did a GARP model. What is GARP? Any guesses? What does the G stand for? Or the Q? Growth? Or what? What's my Q? Quality? And what's the rest of it? The A is a really small word. At a, and what's the last? Reasonable price. Reasonable. So if you don't have a strategy, use GARP, use QUARP. I'm a QUARP person. I like quality at a reasonable price. That's what, so you're stuck with that because I built your screening model. What does the screening model look at? It wants high quality companies, just like good turnover, good margins, low debt, but I don't want to be real expensive. That's my definition of a good company. Good company is that. What's a good stock? It's one that's cheap relative to its quality. Pretty easy answer, right? So I love asking that question. And so you have that in your final analysis, you have it in your screening model, so it all lines up. Once you have that, so you've done all of that, now you're going to do valuation. And so you're going to see this in the model. What kind of valuation you're going to do? DCF, relative valuation, and then the traditional investment bank model. There's a major flaw in the investment bank model we'll talk about. And I'll show you how to correct it in the capital IQ model because they don't correct it there, but there is one. And then I like to summarize it how? Remember my summary? So football chart, I don't like saying the word football this season because my my five teams are like 10, 10, and 1 right now. And then you have a recommendation. You're probably gonna have a target price. We'll talk about that. But that's what you do. And your job as an analyst, you know your industry and you screen down for companies to look at and then you do that analysis. The financial analysis, you need to give me that entire thing, short-term viability, long-term growth, liquidity, solvency, turnover margin, return on capital. Is that the perfect model? It's good enough to get you started. And then as you learn, you can get a lot better. Next semester, hopefully a lot of y'all will take next semester. What's going to be exciting about next semester is we're really going to get into industries you probably haven't touched yet. And I do have some really good industry experts. Like my best friend is a really good financial service. I could probably do financial services, but I'll let him talk about it. We have a couple of healthcare people. I'm actually having lunch on Monday with not healthcare, with a energy person. I'm having lunch Monday with the energy person. I still haven't gotten the healthcare guy yet. I'm going to keep trying until I can get them. We actually have Valero, a person from Valero who wants to help us on energy side. So we have some energy. So we're going to take some really tough industries and we're going to take more time learning the industry. So on financial analysis, we talked about turnover. For financials, I've never heard anyone say the word turnover for financials. It's a very, very different model. We have to use very different ratios for financials. And not only that, we use very different terms for banks than we use for insurance companies. And not only that, we use very different terms for life insurers than we do for property casualty insurers. You see how complicated it gets? So Sebastian and Luke, is life insurance complicated? Are y'all discovering that? Yeah. Very, very difficult industry, right? So that's what we'll do next semester. So I have experts come in and help as much as you can. I'm not an expert on healthcare, but if I can get Tyler Graver to come in, he is. He's like a really good expert on that. So we're going to have some good help to give you some advantages on those industries. But the basic is there. It's long-term growth and it has to do with revenues. It's just with the financials and banks. I mean, with insurance companies and banks, it's a different type of analysis. They don't have working capital, but it's a different type of analysis. So the big picture still works. And we get down to valuation. You can do banks and others very similarly. It's just that banks and insurance companies don't have free cash flows the way other institutions do. So there's some adjustments we got to make. But the industries you're doing this semester, this is a template, looks really well. And when you sit down in your first job, they may give you some training, but they may not. If they don't, just do what you do in this class. But the problem is, if this in class is 100%, I got to look it up. You haven't done a good job. There's got to be some, don't you think there's got to be some retention? If everything you learn in college, you forget 3 months after you graduate, would that be a good use of 4 years of your life? Do you think? I talked to an alum last week and I asked him, he graduated 10 years ago. And I asked him, what is DC cuts I? Do any of y'all remember DC cuts I? Like, do you think he remembered it 10 years ago? He remembered the entire thing. Pretty good, huh? So his retention was pretty good. I was like, that's really impressive. He's not even in that industry. He's working for uh, Expedia. They don't even do DC cut size. So yeah, I mean, so you should retain this stuff. So keep this somewhere, maybe put this in your wallet. So if you get a question, but that's my question. How would you, if I were interviewing you, tell me what is a good company, what is good stock? I would start with the industry. A good company is in a good industry. How long could I talk, do you think? I said, if you tell me, Ron, you got to talk until as long as you possibly can, and you cannot repeat yourself. How long do you think I could go? So we have a competition? 5 days. I don't know about that. What do you think the typical finance major graduating could do? It's less than 30 seconds because I've interviewed about 100 of them. And it's not good. I mean, you're a different group, you're a much higher group, but still, how long could you go? Not with your notes off the top of your head. All right. So next Tuesday we'll do some of that. But we've got to start retaining stuff because your employer is going to expect you. So I know some students is like what they teach us in college isn't they don't use it in real life. So I'll just do enough to get the grade. But they actually do. I went back and looked at my transcript from UT Austin. I had 236 hours of undergraduate. It took me a long time. And I went through every class and thought, do I remember anything from that class? And over 50% of them, I could tell you a significant amount from what I learned in that class. So you should be like, is there 50% of your classes UTSA? You could sit down and tell someone what you learned in that class. That's what you got to get to. Otherwise, you're wasting your time. The taxpayers of Texas that pay for a good chunk of your education is wasting their money. So I'm trying to guilt you into getting your money out of doing this and set you up for success when you start your career. All right. All right. So we're looking at this valuation model and what we said last time. Oh, one last thing. I'm starting to copy economist articles as I get them. I put this out there on Canvas. There's an article on the semiconductor industry. There's an article on travel and leisure that was really interesting. So the wealthy don't like luxury goods, but they like luxury travel. That's kind of interesting. That's why Delta's doing, United are doing so well right now. There's the digital currencies, and I don't know why I put that one in there. That may not apply. This is the Ellisons buying TikTok and some other firms. I thought that was pretty interesting for the media guys. I thought that was kind of interesting. Here's an article on data centers, another semiconductors, telecom. Here's an article on on the aerospace industry. That's probably Paul's, right? Is Paul doing that one? So I don't know. Do any of y'all have an economist subscription? It may be too expensive for you poor undergraduate students, but I love it. I consume it Friday, Saturday, and Sunday. I get through the whole thing. I love it. I really, really enjoy reading it. I read it on my bike, and when I see an article I like, I take a picture of it, and then I get home. Sometimes I go 2 weeks and I have like 40 pictures, and I got to go through and find all these articles. But really, I think the economists, they do great industry articles, and they do great company articles. So if you don't have an economist subscription, send me your company that you're interested in, and I'll put it in Economist on the search, and they may have a good article. It may be from 6 years ago, may not be that good, but they may have one in the last couple of years. They had one on NVIDIA here. Here's one of media again. There's a lot of media ones. This is what the media, they talked about getting more eyeballs, getting people addicted. And now the using social media to get people to actually start spending money. So really, really good articles. They're all really, really, the Economist has some of the best writers out there. So anyway, I hope one of these years I'll see something in Economist. I can write a letter to the editor. I'd love to get into the magazine itself. I think that'd be really cool. But I don't know. I don't know if I have anything to say that they would publish. All right. All right. So we're talking about valuation. So a dividend discount model or a free cash flow dividend discount model, we'll see that with the capital IQ model. It's some definition of cash flow, which usually is a cash flow. A dividend might be their free cash flow, but they may be retaining quite a bit of their free cash flow. Some rate minus some growth rate. And so we're talking about the discount rate, and we got last week, we did the risk-free rate where we're using the 10-year treasury. We got the market risk premium. You don't need to write about that. You don't need to talk about the risk-free rate or market risk premium, but you do need to come up with a number. You need to document how you're doing it. You'll probably do it once and use that. You will do it once and use it for all of your companies, right? But beta, you do need to put some work individually to your companies on beta. So we talked about beta. So beta is how you adjust your company's risk relative to all the other companies. What's the beta of the stock market? One. So what's the stock market? Usually which one? S&P 500. Is that what William Sharp meant? What's it called? What's the name of the model? Capital asset pricing model. What's a capital asset? Does that include real estate? And so he should have called it US large cap, not capital asset. And what kind of price does it give you? Doesn't give you a price, does it? He should have called it US large cap, give you a discount rate model is what he should have called it, but he called it CAPM. But usually it's the S&P 500. So if you're doing a small company, you may need to add another premium on top of that if you're doing a non-US company. But where can you get those premiums? I remember the source there. Dr. Damodaran, right? Damodaran will give you some good premiums. So what's a small company? I don't know, less than 5,000, definitely 5 billion, definitely less than 10 billion, maybe. So, you have to kind of, if you're not sure, if you're doing NVIDIA, is that a small company? Pretty safe on that one, right? So, so it's a way to get the discount rate. So it doesn't price anything, but it gives you a discount rate. So it's a way to get a discount rate for your company that's specific to its risk. All right. Is it used in practice? Yeah, it is used in practice. You'll see it in the Capital IQ model. Some of my students are taking the CFI Corporate Finance Institute's financial modeling valuation analysis, and they do a great job on everything but beta. And for them, beta is just a number you look up in Yahoo Finance, so they don't put much effort into it. I don't know why they don't talk about it more. So we got to do more than that. We're going to say cyclical firms that are very sensitive to the economy are going to have a higher beta. We're going to consider those more risky. Why? Because when the economy tanks, the stock market crashes, and you have a stock that when the market's down, it's down even more. So the market's down 10%, it's down 14, 15, 20%. And then you have defensive stocks. Those are the ones that they may be hurt in a recession, but not hurt as much. So if the stock market's down 20%, they may be down 2 or 3%. Or like Walmart was up a fraction in 2008, not a bunch, but up a fraction. So it protected you some. So what's the formula for beta? What's the formula for correlation? What's the formula for standard deviation? You know, those three formulas are almost identical, right? What's the formula for correlation? Blank divided by what? By what? Covariance divided by standard deviation. Well, what's beta? I remember I said the formulas are very similar. Covariance divided by what? Standard deviation times, but which standard deviation? So beta, does it include stock specific risk or only systematic risk? So are you going to have the stocks standard deviation in beta? So what is the standard deviation? It's the market, right? So what about correlation? Is the stocks specific risk important there? So there you have the market, and here what do you have? You have the individual. All right, so it's a formula. You can calculate it. What is it in Excel? It's the slope function. So you just do the slope function, but make sure you do the stock first and then the market, and that will give you the beta. So yeah, there's a high, and standard deviation is very similar as well. But yeah, so you're looking at with beta. So with correlation, you can only be -1 to +1. How high can beta be? What's the highest beta you can get? I mean, in practice, it could be 6 trillion, right? If you borrow $1 billion and put it all into and the put options on the S&P 500 or something, you're going to have, or on call option the S&P 500, you can get a really high beta, right? If the market moves a little bit, you're going to be up quite a bit. So there's no limit. But for stocks, what's the typical limit? So I typically say I will go down to 0.4 I will go up to 3, below 0.4. You can see Walmart has negative betas for 5-year periods quite frequently. They have in the last few years had a negative beta. If you have a negative beta, what does that imply for your model? It implies your stock's required return is lower than the risk-free rate. So if I tell you there's some gold company as a negative beta, so you can buy a 10-year treasury yielding 4%, and you price the stock and you think it's going to yield 2%, would you buy that stock? Give you 2% when you can buy treasuries at 4%? I wouldn't. Seems like a terrible thing to do. So we're not doing materials this semester. Sometimes we'd say gold stocks have a negative beta. Probably, I don't know if it worked so much this year because the stock market's up and gold's up a bunch this year. It's hard to say. Gold this year, gold is like gold goes up if the stock market's going down, but if the stock market's going up, gold goes up. I mean, that's all it's done this year, right? It just goes up. If the dollar comes down, gold goes up. If Trump says something, gold goes up. If Trump doesn't say something, gold goes up. So this year, it's hard to say what gold's doing. So I typically don't go much out of that range. So what would be a 0.4, do you think? Which team in here is going to have a 0.4 maybe? Staples probably, grocery stores could go down to 0.4. It's tempting to use a 0.2 for Walmart because its beta has been so low for some periods of time, but I get uncomfortable at 0.4. And which industry is going to have a 3 in this group? Probably industrials, probably consumer discretionary. Tech, I don't think so. I don't know. Y'all can debate tech, communication services, you can debate. Are people going to cancel their Disney subscription? What's the first thing they're going to cancel if they're worried about losing their job? Disney might be the last thing they cancel, right?
For the formula for beta, why is the standard deviation of likely found the same?
Well, you can square it if you like. It's the volatility of the market, right? I was just showing, the reason I do it like that is because it makes the two formulas look practically identical, right? It just makes, it's times, but yeah, you can use the volatility of the market. All right, so you've got to decide. I'm not saying that has to be your range, but if you get outside of the range, especially on the low end, you start getting to a point. Remember, your growth rate can't be bigger than your discount rate. Your beta gets low enough, you start getting a really low discount rate, and it starts becoming a challenge where you have a discount rate of 5% and your growth rate's 4.9. You end up with a stock price of like $80,000 or something. You're like, what do I do with that? So you have to be a little cautious of that. All right, so in the spreadsheet that you'll have, one of the things I like to do is a rolling beta. And I've had some other professors here say, Ron, why do your students do this? I don't know what happened to my chart. That's really strange. So why do I do this? Well, years and years and years ago, when I first started teaching this class, I invited one of our portfolio managers. He's a guy up on the East Coast. I forget the name of the firm, DSI or something. It's a firm that sounds like a big firm today, but they weren't. They're a small firm. But he came and he says, okay, professor, I'll talk to your class, but I may be contradicting what you're teaching them. So that's fine with me. He showed a rolling beta chart of Merck, the pharmaceutical, and it was just like that. And he says, this is Merck. Did they sell pharmaceuticals and then they decided for 3 years to sell automobiles and then they decided to sell groceries and they went back to pharmaceuticals. Why is it like that? And you can see that with some of these firms, right? Their beta. This is a rolling 5-year monthly beta. It's all over the place. And his solution was, I don't think CAPM works. And so that's why he showed me that. So you'll see my philosophy. I do like this. So the spreadsheet is set up to give you a rolling beta for 3 companies. So you bring those, you type the tickers in here and we'll bring those. So your main company and 2 competitors. You can look at that. If you want to look at their debt to equity over time, you can do that as well to see how different that is, to see if that's influencing it. But you can see Walmart the last few years, the blue line has had a much lower beta. here's 0.4. Remember I said 0.4 is kind of my minimum. You can see Walmart has been really, really far down there. And Costco, you might be surprised that Costco's beta is consistently higher than Walmart's. And why would that be? Is Costco have more debt, or is, you think of Costco, that podcast talked about Costco having a higher income clientele than Walmart. You would think that would make them a lower beta. Those people probably spend no matter what, but Costco is higher. And then as you'd expect, Target is higher throughout. So you can do this comparing different companies to give you some sense, but that's just the history. You need a beta for the company going forward. The CFI does, and you can do this if you like. We can talk about, they do an unlevered beta for the industry, and then they levered it up for your company. My issue with that is there's like this 2-3 decimal place precision with that you get exactly right. But does this look like 2 to 3 decimal places precision? You expect betas to come down over time as Walmart especially becomes kind of the go-to discount store. But if you had valued Walmart right here, should Walmart have a 1.36 beta? Even in 1991, does that make sense for a Walmart? It's kind of a high beta. What about down here? 0. Would you ever buy Walmart if their expected return was exactly the same as the 10-year treasury? I wouldn't. I'll just buy the 10-year treasury. Why go through all that? They can do some stupid stuff. So well, the 10-year treasury could do some stupid stuff too. But anyway, so you have this. One thing you have to do with this is it's set up to go back to this date. If you do a firm that doesn't have that much history, you'll have to change the starting date and just see if you can get a better date. But it's set up in Bloomberg. It brings in the data, so you have that pretty quickly to look at. The person helping you on your stocks may have no clue what beta is. I don't know, Joshua, you can get into that with them on Friday, but to understand what beta is. But if not, they can come back to me, talk to people, or if you want to teach them, you can teach them just as well. So I like the rolling beta, but I have a process that I'm going to show you that I want you to go through. You don't have to have it as part of your presentation. In fact, your presentation, you probably won't spend a whole lot of time on how you came up with beta. You need to spend the time on beta so you're comfortable with what it is, but it probably won't be a big part of your presentation. I don't think y'all even mentioned beta in your presentation, did you? You had one, right? You valued your company, but it tends to be something that's in the background. So I have a 4-step process for determining beta. I've been using this for years. And then I watched the Motorin's class, and he has the exact same 4-step process. I didn't steal it from him. I'm 100% sure he didn't steal it from me. So a great mind and my mind came up with the same thing kind of independently somehow. I don't know how. He's obviously a lot smarter than I am, but I'm capable of equaling him occasionally. So the first step, I think, is the most obvious, is what kind of company is this? Cyclical, defensive, in between. Start with that. And you can have some debate and discussions on this. There is some debate. So the Motorin talks about Ferrari. Is Ferrari a high beta or low beta stock? And you personally go, wow, it's a car company. Obviously, that's high beta. But then he says, well, who buys Ferraris? Billionaires. Well, billionaires, a Ferrari is a pretty cheap purchase for them. That's probably like us going and buying a loaf of bread. So maybe it's not a high beta company. We had the CEO from Santigos talk to the Investment Society, and he says, I bet, are any of y'all in that conversation? Yeah, really good presentation. That was just good. I remember Tim from USA, really impressive guy. But he said, you might think a movie theater is a high beta, but you might be surprised. You look at a movie theater versus going to SeaWorld. Have y'all been to SeaWorld in a while? Have any of y'all mortgaged your house so you can go to SeaWorld? Pretty expensive, isn't it, for a family of 4? I don't know what a movie ticket is because I never go to movies, but it's a lot cheaper than going to SeaWorld for a family. But is the digital world changing that? People are going to start doing this from home. But he was saying, from a compared to the other things right now, movie theaters are not that expensive for a family that's got to do something together. That's not a bad option. So maybe it's not as high beta as you think. So there is some debate on some of these companies, but figure out where your company is. I usually think about this is the revenue change relative to economic change. How sensitive is the revenue of the firm to the overall economy? So if you go into recession, are they going to see the revenues fall more than the average company or see the revenues fall less? Yeah, they may all fall because maybe a really bad recession, but we're talking relative to the average company where their revenues fall more or less. And just think through that. Some students actually go back to a recession and look at their company. The problem with that, every recession is very, very different. And I think that's the reason why the line's like that, because CAPM is a one factor model, but there's a lot of factors out there. So 2008, we had a financial crisis. Guess which industries beta shot up to 2.5? Banks, right? You look at betas for banks, they shot up to 2.5. Why? Because it's a financial crisis. Guess what betas shot up to 2.5 and 3 in 2000 and 2001? Tech stocks. Why? Because we had a dot-com crisis. So betas are going to somewhat reflect the actual economic time that's going on. But if you talk about kind of a garden variety recession, I don't know if we've had one of those, but if you can think about, how would you expect this company's revenues to respond? The next thing you're going to do there after that is 2 steps related to leverage. So what kind of leverages do we have? Y'all remember the 2 that have had me before? Operating and financial. So you start with those. So what does leverage do? So you have revenue on the top line. What does leverage do? It talks about how volatile net income can be once it goes through that. So you have some fixed costs in your structure. Operating leverage is fixed costs other than interest expense. I read a book. I may show you their chart. They have a really good discussion on operating leverage and how they broke it out into 4 different components. I thought that was really, really fascinating. I might show that to you. But it's essentially the fixed cost nature of the business. Because if you have more fixed costs, what's going to happen? If your revenues fall, your net income is going to fall a whole lot more because you got to keep paying those costs. If you have a variable structure, your revenues fall 10%, your expenses fall 10%, your net income doesn't move that much. There's a good article comparing Netflix to Spotify. I think it was Spotify. Spotify, did they do recordings? Music guys? Yeah. So I think it's, but I don't use Spotify. We tried our podcast on Spotify and we got 0 listeners. So we gave up. Now we're on YouTube when we get 80 listeners. So a little better. But they said Netflix is producing its own shows. Massive, massive fixed costs. Spotify is licensing all this stuff. Variable costs. So what does that imply for beta? Who has the higher beta from that standpoint? Netflix should. Now, is that negative for Netflix? Well, no, because if Netflix is doing well, what happens to operating fixed costs? Their net income is going to shoot up. What happens to Spotify? They're doing great. Their licensing goes up. Their expenses go up. So operating leverage is wonderful on the upside and terrible on the downside. But from a beta standpoint, high fixed costs implies a much higher beta for Netflix than for Spotify. We could go test it, right? You could do my rolling beta chart for those 2 firms and see if Spotify does have the lower beta because of the higher variable costs. But that's one example. So what are fixed costs? You have pharmaceuticals, you have massive research and development costs, you have a lot of salaried employees, got a lot of scientists. You don't want to let them go because if you let them go in a recession, they're going to go to your competitors. NVIDIA's got a lot of employees. They don't want to let go. They're going to hold on to them, or they'll start their own firm. So you have salaried employees you're going to hold on to. Those are fixed costs. They're pretty expensive fixed costs. You have a lot of property, plant, and equipment. You can get a lot of depreciation from that. I know it's a non-cash, but that is going to make your income look a lot more volatile. There are certain fixed costs that are pretty obvious. If you have a heavily unionized workforce, especially on the industrial side, that tends to give you fixed costs that you really can't do much about because of those contracts you have. So operating leverage has a huge impact on beta. Generally, operating leverage tends to be industry related. For the most part, I just kind of contradicted that with Netflix and Spotify, but generally firms in the same industry have similar operating types of leverage. Target and Walmart and Costco have very similar type of operating leverage. And there are some differences. Obviously, Costco does their warehousing differently, but generally they're very, very similar. And then financial leverage is just the amount of debt, capital structure. Firms with higher debt are going to have higher betas, firms with lower debt, lower betas. Now, this again is industry specific. We're going to compare it against the market, and I'll show you the spreadsheet for that. But certain industries have high debt, and certain industries have low debt. So utilities have a whole lot of debt. Why? Because they got wonderful assets sitting there. They got great collateral. They can afford a lot of debt. A lot of tech companies have zero debt because they don't have anything. They just have a service they're providing, right? They don't have assets. They don't have inventory. And so it probably would make more sense to compare and that's why the levered versus unlevered beta makes a lot of sense when you're comparing companies. And we'll see it when we look at the Capital IQ model. But looking at the debt structure, but I'll show you overall on those. So here's one of my theories on operating leverage. I haven't heard the Modrens say this, but this is my theory. If firms have high fixed costs, this would imply higher EBIT margin volatility. So that's my theory. If a firm has a lot of fixed costs, their EBIT volatility should be higher than a firm with low fixed costs. I can't prove that to you mathematically, but that's just my philosophy. And it seems kind of obvious, right? If you have costs you got to spend, no matter what your revenue do, your margins are going to be pretty volatile. So what I have in the spreadsheet, and some of y'all have seen this before, is this operating and financial leverage thing here. So I've got Walmart set up here. I did it two ways. I did debt to equity on the debt side, but a lot of your firms don't have equity. It's negative. And so I did somewhat of a proxy. We're just trying to generally see, is this firm high debt or low debt? So I did debt to assets. So you can, if you don't have the equity. So it's set up to do debt to equity. So first step you do is go find your company on the next page or wherever that is. Go find your company. So let's do, let's do Target. There's Target. They're on line 2605. So I change this to 2605. Brings in Target. And look at me. You think I'm too old to learn a new trick? Y'all notice my formula up there? What am I using now? X lookup. Aren't y'all proud of me? I finally got rid of V lookup and I'm using X lookup now. I can learn new tricks. So here's Target's debt to equity. Their debt to equity is 136%. The typical stock is 57%. I have to admit, this is the Russell 3000, not the S&P 500, but does Target have a below average debt or above average debt? Quite a bit above average debt. And then here's the gross margin standard deviation. It's 2%. The typical stock is 4%. Their EBIT margin is about half as volatile as a typical stock. You would expect that with Target, with a lot of hourly workers. Obviously, they're going to raise and lower their prices as their cost of goods go up and down. Pretty low volatility. On their net margin, the typical stock's net margin has or EBIT margin volatility I'm sorry, this was gross margin. I forget, that's gross margin and net margin. Their net margin standard deviation is 1.16. Typical stock's 8.3%, pretty low volatility. I could do Costco. So I go in here and find Costco. Line 649. What does their debt look like? Below average. How's their gross margin volatility? It's not even a 0.5%. Pretty stable gross margins. What about their net margin? Pretty stable. Any of y'all doing Costco? Any of y'all want to forecast Costco? Here's the gross margins: 12, 12, 13, 12, 12, 12, 12, 12, 13, 13, 12, 13, 13. What's your forecast for their gross margin? 12.5 maybe? 13. What about their net margin? 3, 3, 3, 3, 3, 3, 3. Oh, 2, man, they had a horrible year. 3, 3, 3, 3, 3, 3, 3, 3. Anybody want to forecast Costco's EBIT margin? Pretty simple, right? This is a firm, pretty straightforward what they're going to do. If they find a way to save money, they just give it to the customer. Pretty simple firm to forecast. What if we do Tesla? 2681. Pretty low debt. What about their gross margin? 18%. Pretty high. What about their net margins? Any guesses on that? High or low? Oh, you think it's low? Or it's a little high. So Tesla is auto dealer who's still fairly young. This is going back 10 years, so it's still pretty young. I mean, you can look at Tesla. Here's the gross margins. 88% negative. How do you have a negative 8% gross margin? How do you sell your cars for less than what it costs you to make them? That's pretty horrible. 9%, 26, 30%, 7, 23, 28, 23, 23, 19. It's getting a little more predictable, right? So it's starting to, but it's still a lot more difficult to forecast than a Costco. So you could probably throw out those earlier years. What about their net margin? It's just insane, especially in the early years. Negative 109,000%, negative 500%. Took them a while just to make money. Now they start making money, and then not only is they're making money, but they have a much higher net margin than their competitors. But the standard deviation is really high. Does that mean they have higher fixed costs? That's somewhat of my theory. I know there's other things going on with Tesla other than just their fixed costs, but I do think Tesla has a lot higher fixed costs than a Walmart or a Costco for sure. So it's my theory. It gives you some indication. You get the debt side. You get some sense of their fixed costs. So look at those, consider those, think about them both from a standpoint of what you think makes sense, just from what you know about the firm, but then just look at their numbers and see if that makes sense. I've lost my where did it go? Is this it? Where did I put that? I've lost where I've been typing. The middle one? What's the middle one? Ah, the middle one. All right. All right. So what kind of company is it? Let's talk about the revenues. What kind of leverage does it have? Operating financial leverage. That's going to tell you how volatile it is, which is going to raise or lower its beta. And then anyone remember the last one? 5-year. Yeah, look at its history. And I like to use the rolling history. And I like to use the rolling history versus key peers. I really think that gives you great insight into the firm. If I'm thinking, wow, Walmart's a high beta stock, and I come look and I say, well, it was a high beta stock back here, but man, the last 20 years, it's been a really low beta stock. Then there's maybe something wrong with my analysis. I'm gonna look back to see what I should be assuming. What isn't the beta for your company? Yeah. Yahoo Finance. So what is Yahoo Finance? What number are they showing you? Let's look at Walmart. It's a 5-year rolling. 5-year monthly, exactly what I'm doing, but what is this number right here? Versus what I'm showing you. Is that number you saw on that page, 0.67, anywhere on this chart? It's right there, right? It's that one dot. All right. What if you pulled up Yahoo Finance right here? You'd be buying a boatload of Walmart stock, wouldn't you? You use a 0.09 beta for that firm. What if Yahoo Finance is right here? Well, you'd be shorting Walmart stock, wouldn't you? Now, I have a theory. I haven't had a chance to test it, Joshua. This is something you could set up in Python. So I think there is a large percentage of the security analyst world that's using the rolling beta off of Yahoo Finance. So what does that mean? If that's the case, then stocks whose beta is unusually high should be undervalued, and people should be avoiding that. It'd be a great time to buy it. And stocks whose beta is unusually low, if everybody's using that, that stock should be overvalued, and that's when you should avoid it. So I would argue that if you look at the normal median over a long period of time, when it gets out of whack with that, especially if you have a kind of an RSI, kind of a quick move. If people are actually using it at the value of the stock, then they should be making some bad decisions, right? The difference between Walmart there and Walmart there, that's a pretty radical, and you're talking about a 70-80% difference in price valuation between those two betas. If people are just using beta right off of Yahoo Finance, you should see those massive, massive swings. But I don't know if that's true. But that'd be interesting, right? To see if people are actually doing that. Because you can bring in, and I don't have it in here, you can bring in equity beta from Bloomberg, and it's probably going to be that 0.67. Bloomberg has the adjusted beta. What is the adjusted beta? That sounds good, right? It's beta, but we adjusted it. Do you adjust things to make them better, or do you adjust them to make them worse? Hopefully better. So how does Bloomberg make their beta better? That's hard to say. That's a good question. If someone asks that question and Bloomberg's like, we're not really sure. They found that someone wrote a paper in the 70s that said betas generally move toward 1. And so their adjusted beta just takes the beta and moves it closer to 1. If it's above 1, it moves it closer to 1. If it's below 1, it moves it closer to 1. That's their adjusted beta. Does that sound any good? It's essentially this number right here plus a little bit to get it closer to 1. So I don't know if that's all that much better. So those are the sources that you have. You can bring in an equity beta, but my bottom line is what? Beta is a what? A forecast, not a number you look up Yahoo Finance. That's my position. All right. Does anybody agree with me? Well, just go into Google and ask, is beta dead? And unfortunately, this Walking Dead thing started coming up. So let me put CAPM in here. That used not to be the case in the past. I don't even know what that is. But you'll get all kinds of articles on is beta dead? Is beta dead again? CAPM is not dead. I think that the Motor is the one who said CAPM is the worst model out there except for all the others. So there's a big debate. I like CAPM. I like beta. If you view beta as a forecast the same way your growth rate is a forecast. Does it make sense? The value of firm where all you do is just take their historical growth rate and apply it to the future? If you did that for NVIDIA, how would that look? You're a pretty valuable firm, wouldn't it? You put a 50% growth rate on NVIDIA for an eternity, that would be a pretty, well, you get a negative number because the growth rate would be greater than the discount rate. So if growth rates don't make sense historically, then betas need to be, because the firm could be changing the historical beta. And that's the problem with using historical beta is where are you in the cycle right now? Walmart 6.7 is actually at a pretty high level versus where they've been it's actually, you're at the highest level they've been in the last 20 years almost. Has Walmart changed? So they started selling cars, you notice, car dealerships, they're selling probably more produce now than they were 10 years ago or 20 years ago. So they're probably even lower beta than they were back then. So why are they up like that? Well, just That's just the noise in beta. There's a lot of noise in these numbers. So it's a forecast. It's not a number you look up in Yahoo Finance. That's the process you want to do. When you do that in the Excel spreadsheet, you get the chart, you get the operating leverage, you put all that in there. And when you come to the discount rate, you need to come up with your assumptions. I do it by looking at the four pieces, and then it's very subjective. I look through my base case is what I feel is right in the middle of where the stock should be versus, where it's been historically and what I think it is as a company. The bull case is the lowest beta you can get. The bear case is your highest beta because the lower the beta, the higher the valuation, the higher the beta. And then I put some comments over there. So it's essentially the subjective looking at it. What a lot of people do is, well, first of all, with Walmart, I would probably kick out anything before like 2004. Walmart was a much smaller company back here, a very different company back here. So I might say, well, let me take it let me take the last 20 years. And what a lot of people will do is just look at the median. The median here looks like it's about 0.4. I could use a 0.5, 0.4 for Walmart. I'm actually don't like 0.4 for Walmart because they don't just do groceries. To me, groceries is kind of like the low end of the consumer staples. They do sell more expensive stuff. So I'd probably put them a little bit higher than that. I definitely wouldn't, I think 0.67 is getting up to the higher, it'd be a little bit on my high end. I definitely wouldn't use anything close to zero. So for me, my base case was 0.45, bull at 0.3, bear at 0.65, which is kind of where they are today, but very, very subjective. But you use that range. The CFI on their models, they do very beta in their model. They just never tell you how to come up with beta. So you're kind of just like, where'd they get that number? And they say, and your beta is so-and-so. And he's like, yeah, how do you know? So that's kind of a weakness on theirs. All right, so that should give you a discount rate. I don't actually have the discount rate in here, but it's going to be on the valuation side. Somewhere in here, I'll put the discount rate. So, oh, here's the discount rate. So there's my discount rates. 6% is my base case. If you believe Walmart stock was going to return 6% for you, and you can buy 10-year treasuries at 4%. I think 10-year fell below 4 today, didn't it? Did y'all see the market today? Wasn't it scary? Sorry, screaming. I already have Yahoo Finance open. Why am I doing that? So the market was way up and then it was way down. It was down over 1% today. You see that big shift. What happened? Did Trump say something again? I know the bank stocks came out and they had some scary numbers, and that was the ones today, not the ones like previous 2 days. But I don't know if y'all noticed the 10-year, make sure when you go into an interview, you know what the 10-year treasury is. So it fell below 4% today. It fell 7 basis points. Is that a big day or a small day? Pretty big day. One standard deviation, 6.5. So it's 1 sigma days. So the pretty good rally in 10-year bonds today. So back below 4%, I would want to know that if I'm going to an interview that the 10 years below 4% again, because that's a pretty psychological number. I don't have that here, so because I didn't update the 10-year treasury, but using the higher 10-year treasury, I'm probably using a 4.2 here. Would you invest in Walmart stock to make 6% if you can make 4.2 of the US government for 10 years? You have to kind of make that decision. Is that adequate compensation for you? I'm not seeing a strong. If you can make 12% from Walmart, would that be worth it? Probably so. If you can make 4.3% from Walmart, that'd be worth it. So it somewhat makes sense. All right. And then we'll talk about the valuations. On the valuations, what we got to do is bring in the denominator and the numerator. So here, the numerator is going to be that cash flow, and then we need a growth rate. So we're really down to the growth rate. Students ask me, where do I get the growth rate for my stock? Where do you get the growth rate for a stock? From your brain, right? It doesn't exist. There's no place to go look up a growth rate. If you could go look up a growth rate, they wouldn't hire you. They would just have a computer go get the growth rate, stick it in the formula. So again, it's what I complain about in undergraduate. We give you all the hard stuff and have you calculate the easy stuff. Well, now you got to go find the hard stuff, finding the growth in this. Some of y'all have done it, right? Some of y'all took my investment class. So you got to write papers 3 and 4. So you have to come up with growth rate. We'll talk about how you can do that. I give you some historical growth rates on basic earnings per share, EBITDA, EBIT, net income, revenue, and dividends per share. I give you some basic growth rates. Again, this is Walmart. I also do the PEG ratio. So the PEG ratio will give you a growth rate for what the market thinks, because the PEG ratio is the PE ratio divided by what the market thinks growth is going to be. So you get the PE ratio, you get the PEG ratio, you can back in the growth. For Walmart, their PE ratio is 34, their PEG ratio is 4. You divide 34 by 4, you get a growth rate of 8%. Real straightforward. But why wouldn't you use that number? Well, that's what the market thinks. What is your boss hiring you to do? They want to know what you think. So that just gives you a basis of what other people think. So you have history. That's fine. Walmart's history over 10 years is pretty pathetic. Their earnings have grown compound annual growth rate 2% the last 10 years. That's not even inflation. You would think they would grow with what? At worst case, number of stores growth and inflation. Now they actually had store growth flats. So essentially what did they do? They just raised the prices with inflation. They didn't get any new traffic. They didn't sell any new stuff. That's not an exciting story, is this? So pretty weak. But the last few years, it's been pretty strong. The other thing you can use is the sustainable growth model, which says your growth rate is your return on equity times your retention. Because if you retain more, you should grow faster. If you pay out more, you should grow more slowly. That can give you somewhat of an indication. What's the problem with this? Dr. Arnott, I don't know if he's a doctor, Randy Arnott, he actually went out and looked at that. He looked at firms with high payout ratios and low payout ratios. We think firms with high payouts should grow more slowly because they're paying out more. Firms with low payouts should have high growth rates. And what did he find? The exact opposite. But I think that's a flaw in his data collection, because in 2008, what happened to payout ratios in 2008? Did they go up or come down during the financial crisis?
They go down.
They go down. And what did growth rates do in 2008? They go up or come down? They came down. So the problem, I think, with what Arnaud did is, why do people cut their payout? It could be they have great growth prospects, great growth products, and they can do good projects. But it could be they're scared to death and you're just clinging on to all their cash during a crisis. So I think that's part of Arnaud's. So I think the theory's fine. So Walmart's ROE was 24%. Their payout was 34. So their retention is 65%. So you take the ROE times 1 minus their payout, you get 16. That seems really high. One thing to always think about here is normalizing. So what do you do with normalizing? With normalizing, I might have done this for you. We'll see. Where's my Bloomberg data? No, I didn't. I should have done this. So one thing on the this ROE approach is, if their ROEs have been 10%, 12%, 11%, 12%, 35%, that 35 might not be a normal number. There's got to be something really strange that happened. And in that case, you might want to normalize it to a more normal year, because it could have just been an accounting thing that went on. So you might look over a few years. So there's 3 approaches there. You can look at history. You can look at what the market says through the PEG ratio. You can look at the sustainable growth model. And then the last thing you can do is just go to Bloomberg. And you just go into Bloomberg and type your ticker, the function 8 key, and type EE and change it to annual. And you will get annual forecasts for your companies. I think you can do, you might be able to do revenue. You can do revenue, earnings per share of the, yeah, here's revenue here. Here's their earnings per share. You might be able to do dividends. So when we do the capital IQ model, you might want to look at this to kind of compare to see if it's not that you have to match these numbers, but you do get a pretty decent forecast out of Bloomberg from the analysts that are covering the firm. So you need some growth rates. What growth rates do you use? Whatever you think is right. I can't tell you what you think Walmart's going to do the next, how many years? 7,500 years? I don't know. I don't even know if Walmart will be in business in 75 years. So who knows? When I was a kid, I was amazed by Kmart and Sears. They were like the greatest companies around. Business Week wrote an article about how wonderful Circuit City was, one of the greatest companies in the world. It was insolvent a few years later. You know, if you'd asked me in 1982 about Sears and Kmart, what would I have said? Oh, of course they'll be here. I'll ride my bike to Kmart every week. Of course, Kmart will be here in 500 years. Blockbuster will be here in 500 years. Everybody goes to Blockbuster. We love it. Toys R Us. Oh my word, the greatest company. I love it. I got a great theme song. Of course, they're going to be here 100 years from now. So Nvidia, they're going to be here 100 years from now. I hope not. I hope someone better comes along and takes them out. But as far as we know, they are. So it's pretty tough to come up with an assumption. So you use a range and you have to figure out on your range how wide you're going to go. On Walmart, I think at a minimum, they'll grow with population plus inflation. They should kind of do that, kind of 4% maybe. We'll talk about next class. We'll get into the H model with your long-term versus your short-term comparison. But put those in there. You have your cash flows. I have dividend and I have free cash flow per share. Got my discount rate, and you come up with your valuations. And so when you come with your valuations, you can compare it to the actual price. Look how wide the range is. So I have students say, man, that range is so wide. How can that possibly be correct? So if I show you, I should bring you the CFAs. The one I had on my exam, they did Merck, and they did like 150 something scenarios, and the range is from $30 to $150, something pretty wide. You can go pretty wide. This is Walmart, a much easier firm to value than Nvidia. If y'all do Nvidia, y'all going to do Nvidia, tech people? You're going to get a wide range. Right? What is Nvidia going to grow in the next 100 years? Right. Something between negative 100% and 17,000%. Who knows? It's a massive, so it's pretty tough to do. So when you do this, when we get into the football chart, essentially what you're going to do is you're going to, if we do a DCF, you're going to put your low value in here. Put your high value in here. And it will build, we'll start building your model. I'm going to do the H model. Put my low value in here. My high value in here. And I start having my chart getting built. What are our other approaches? Anybody remember? Well, this is actually using free cash flow for my dividend. So what are those other approaches? So relative valuation, we'll definitely couple that next week. I do have a model that's set up. I think it works pretty well. Some of these models I'm discovering small errors in the way the formulas work that I may fix them as we go over time. But you find one, let me know. They're minor ones. They're pretty easy to fix and you'll notice them. But I want to get them so they're pretty straightforward. And then the capital IQ model. So we have 4 models that we're going to use. We have 2 valuations and a relative value. The relative value model, we'll use the relative value model to price the stock, but we'll also use that relative value model as a key input to the capital IQ model because they need a relative value in one of their inputs. So they're all kind of somewhat tied together. All right, so where should you be in the class? You remember all of this? What is it about your firm that makes them different? You're doing the annual report. You're using ChatGPT, Obvious World, SWOT analysis. You remember all of this? The Bloomberg AID and KI. You're going to do the financial analysis and start getting on the valuation. But So next week in your teams, make sure you show up on your teams. Very, very important. Start showing me your drafts of your stock pitch book. Are y'all doing your drafts in PowerPoint or in Word or in Excel? How are y'all setting it up? And you could do everything in Excel and kind of do text boxes in Excel, I guess. You ultimately going to put it into PowerPoint, so we don't need an actual Word document, but it'd probably be hard to do this in PowerPoint. So I don't know when you get to PowerPoint. If you did it all in Excel, you probably could move it over pretty quickly to PowerPoint. The first part of this is probably going to be a lot of stuff in Word, I would assume. You have these Excel summary files from Bloomberg that you can certainly copy some of those into your PowerPoint. I gave you those videos on stock pick books. You might look at that as well. I gave you the Capital IQ example of one on Amazon. You might look at that as well. Are y'all going to stick with your color coding that you use for the industry analysis, or are you all going to do your own thing? One thing I'll say, some of y'all are using the, we got a couple minutes here. Some of y'all are doing the white background, and that's just not done anymore. So I don't know why. I don't make these decisions, but CFI is real strict on this. You want a non-white background, no border, and that's just, I don't know. I don't know who decided that. At USAA, we went to that, and we had these, I forget the kind of printers. Oh my word, we spent $1 million on ink because we were actually inkjet pinning all these dark backgrounds. It was crazy. My boss especially, he wanted every draft printed out, and it was like we were spending like hundreds of thousands of dollars. But now that you don't print anything out, I guess everybody's fine with that. So whatever your color code is, if it's white, if it's blue, it can't be white, but if it's blue or red or orange or whatever, make sure you're using that consistently. Remember on the color, go in and see the color. Right down here, once you find your color, you can go down and copy the color code and have that. So you're always using exactly that color. Same thing on your lines. Don't use red and green and then use orange and purple and then use, be real consistent. I know that sounds so stupid, but when you put it on LinkedIn, that's what they notice. Who's the first person who sees your LinkedIn? It's going to be the HR people. What do HR people think? Oh, it's so pretty because they don't know finance. So you got to start off with it looking. So there is a formatting thing that opens more doors for you than you realize. So think about that up front, right? Don't build your entire PowerPoint and then you have to go back and you have to start over from scratch. So do it in your Excel because you'll probably copy these from your Excel spreadsheet over.